What? Okay, so here we are all set up with our recording and going into gold, and I just wanted to review this situation for the first part of the session. We talked about gold in our weekly planning and scanning, and I just want to quickly review the breakdown that we've seen in gold over the last 8-9 weeks. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 weeks, 3 months. From this low to this low, these are two big red candles. You can see that gold has had major breakdowns, and these two candles here, these 2 weeks, have pointed out, as you can tell from the prior week's high, it moved on a low volume. Then the market tried to rally back, and it just didn't go anywhere. But as it traded lower in price, it wasn't on decline of the on-balance volume indicator. Finally, we got a big wash down here. So now we have a situation where we have lower closing lows from this week to that week, but we have higher readings in on-balance volume. So if we're entering a seasonally strong period of time and gold has gone down on light volume on a higher degree time frame, which is a weekly basis, we can probably assume, just like over here, same thing kind of happened. Gold went down all this time period, down this whole period. As gold went down, look at the on-balance volume indicator down there, right? It didn't make many sharply newer lows. It's not like this thing just kind of caved and made newer lows. So it was forming over a period of 1, 2, 3, 4, 5 weeks from that low to this low. It's almost the same similar setup with the on-balance volume indicator. So if we take a look at this low, the corresponding low of this week, and on-balance volume, that's the corresponding low. If we take a look at this low and the corresponding low with on-balance volume, again, on-balance volume is higher. So what does that suggest? It suggests that as we enter a seasonally strong period of time, that perhaps if this market does rally, it could go somewhere, and it did. And so we're almost at the same type of setup. I mean, it's amazing how sometimes patterns, manifest and reform over and over again. It's just a matter of being able to identify them. So here's the key. We identified that breakdown was on light volume. We identified a key stopping point was 1240 based on the last conditional change. We did that in this room, and we did that together. Now, all of a sudden, gold pops up, and we say, well, last week we have resistance at around 1278 in gold. It's probably where it should stop. Did you know last week's high was 1278? So we did that last week. So it seems that whatever we're doing, we're analyzing the markets fairly well. So we're giving not only stopping points, turn points, but we're also giving you guys the ability to identify areas to exit trades or to look at points of interest. And so for this week, I'm suggesting that the market has maybe because we have quadruple witching, maybe because we have FOMC, maybe there's a lot of reasons that we could see a reversal somewhere back down, and I would like the market to hold on any key pullback to the 1258 level. Maybe it's 1260, maybe it's 1261, but on a pullback this week, and as long as we maintain a higher low, we're starting to carve out a bottom as we enter not just a seasonal low, but the best time of the year to buy gold. It's the annual low. So this is an important low. This isn't like an intra-seasonal low where, you have multiple, like for example, that's a seasonal low, but in the overall trend is down. So, but it has a time period where it goes up a little bit. So this is a little seasonal low that happens in December, and it goes up, and then it kind of peaks out in February. So with that said, I think we have to be on guard with gold for a pullback in a seasonally strong period of time. And so what I'm talking about is diversification, as they say, is the key to success. You guys have heard me say this a lot of times in the past, that it's not just diversifying your products and diversifying your trades, but diversifying your trading strategy. So perhaps what we do is the first plan of attack, and if we're starting to enter a seasonally strong period of time, and if gold is going to start to enter a bullish trend, it's going to typically bullish trends start off what? When a bull trend starts to begin, it starts off, with making mild moves. It doesn't seem a very aggressive bullish breakouts. So in the early stages of a bull market, you may be able to look at, especially for the July expiration, If we get the pullback to 1258 level, let's say, 1259, if we get that pullback this week, then I would be looking at July expiration credit put spreads in GLD. So that's what planning and scanning is all about. We're looking for a trade and we're planning it out for the week. So when it happens, you don't sit there and scratch your head and say, duh, now what do I do? And that's what a lot of people do. They get that deer in the headlight syndrome. It's like, okay, the market came here, now what do I do? Well, a good trader, they do their homework. When the market gets down where they want to get in, they act on it. So here's a good strategy for this week. When the market moves lower, let's look at, and I'll be back in the office tomorrow, so we'll expand on this. We'll be looking at credit put spreads and GLD for the July expiration. So we got that under the way. Does everyone all right with that? Beautiful. Next, as the market starts to manifest and develop into a bullish trend, now we could start looking at taking directional trades in the market, and possibly for August, or maybe, and I would say August would be the best month, if not maybe September. But my thinking is the August expiration over time would probably be the one that we do a directional strategy. And if we're looking at a directional strategy, I'm probably thinking, if not a ratio back spread, which we'll talk about this week, sell one, buy two. A ratio back is that you sell one, and you need to have the it's a time and it's a ratio spread. You can't be in the spread for closer to 30 days till expiration. So we need something with at least 60 days. So that's one of the things we'll look at. Otherwise, the ratio back spread, we may have to look at the September expiration, because come 30 days to expiration, you got to get out of this. Now, this is something that we do teach in our options course, the ratio back spread. It's very strong directional, but boy, if the market goes, basically what you're doing is you're selling a closer to the money call, and that may sound ludicrous, but let's say you sell a close to the money call with a 45 delta. You're buying two further out of the money options that are 50% of that delta. So 2 of 50% is 100%. So you have two out of the money options versus one closer to the money option. Virtually what you're doing is you're using time with theta to give value to the option. And if the option that you're selling, if the market does pop, guess what happens to the delta? It doesn't really expand as much because you already bought a high delta. But the low deltas that you bought, those are the ones that pop up. So you'll be long, and if you get the deltas, say like the market rallies, think of this math. If the delta on the one you sell is a 45 or 50 delta, and it pops up to 80, what would the two 25 deltas do? They may pop up to 55 or 60. So look at the mathematical difference between the delta appreciations on the two out of the money versus the one in the money. You end up making money as the bottom line. So the moral of the story is you're using the money, the market's money, to finance that trade. That's a very strong directional trade, and we use it every once in a while when we're in a strong directional trend and seasonal time frame of the market. We could also look at, if we don't want to be tied up with any options spreads, we can just simply look at a simple stock replacement, which is a long call, and if we have anything with a 60-day till expiration, we would probably want to be looking at I would say a 60 delta, 55 delta, something like that. But anyway, the point being is there are other strategies that we can look at. In the beginning phases of a bull market, it should be slow and prolonged. That's why on the pullback this week, let's look at a July credit put spread. Then as we get into next week and the week after, as we do start to see if the market pulls back and it starts to act bullishly over the weekly time period, then as we get the market to maybe break out above this last conditional change that I've already put up here, which is 1295 right here, as you start to break out, you not only would you have closed above that last conditional change, but you're also going to have cleared an overhead down trend line. So now we have evidence that suggests that the market could move up, and maybe at the very next level of resistance, we would be looking at the market testing this high here around 1385, 1390 handle. So that would be our major objective for that seasonal trend that runs from July that lasts going into about the first part of September, typically. All right? So those are the things that we're looking at doing that I have planned for you, or planned for myself, more selfishly to think about. So in any event, I think last week we talked about the other thing I want to talk about in our market thoughts and observations is if we're looking at stocks that are entering a seasonally strong period of time, and if we're looking for stocks or sectors that are entering a seasonally weak period of time, what I would like to do is put to use our particular scans that we created, at least with Genesis. And one of the scans that we put together is start to find me stocks that are below a 50-day moving average. So think of the logic behind this. If there's stocks below the 50-day moving average, there's stocks that are below the radar screen of most investors. They're not in a bullish trend. Well, now we got to just do a little bit of homework and find out, are some of these stocks that are below their 50-day moving average, have they been in sectors that are seasonally weak to begin with? Now, what if some of these stocks that are in a 50-day moving average, let's just stick on gold for a minute, are maybe in gold mining sector? And the gold mining sector hasn't been doing that well because gold hasn't been doing that well. So the gold miners might be an area of interest. So we got to start looking for stocks that are under everyone's radar, that are under the 50-day moving average, and they're in sectors that enter a seasonally strong period of time. Inversely, sectors that are going to begin entering a seasonally weak period of time, let's look for stocks that are above their 10-day moving average that are susceptible for a profit-taking correction. So that is what I plan to do all this week with you guys, right there. And that's why it's important, and that's why it started off for this week's. Those are some interesting there's a rhyme and a reason of why we want to look for scans in those areas. It makes logic sense. If a stock hasn't moved because it's in a seasonally weak period of time, what if the stock starts to move? And if it's under the 50-day moving average, if it starts to move higher, it ain't going to be under the 50-day moving average anymore. So we want to start doing our homework there, and that's how we get ahead of the game. For the last 2 weeks, I have repeated to focus on social media and tech names in the MSH sector. And that's why it's in italicized letters, because I just copy-pasted it from the last 2 weeks. So we've been talking about Amazon, Apple, Facebook, Google, MSI, IBM. In Apple, though, we talked about in the room where 94 on the new split price, there was a significant resistance level, which is held. The funny thing is that these tech names that we've been focused on for the last 2 weeks, guess what? This week and next week, you don't want to focus on buying those anymore. So a lot of the names in the technology space, guess what? One of the things that we enter into in technology, in computer, in high tech, and a lot of these names, their big seasonal run, it starts to end in the next week or two. So guess what? Maybe the market peaks out in those sectors and they are all above their 10-day moving average. So we'll probably, believe it or not, be focusing in on some of those areas. So any event, I think we were dead to rights in our analysis in regards to the daily McClellan oscillator, and it suggested that we were entering a bearish or overbought market condition, and we did that a week ago. And I'll bring that up into focus again because I think it's relevant in bringing it back and saying, okay, what is this week? What is the current health of the market? What's the current breadth analysis look like in all the top indices? So let's take a look. Well, we did see a little market pullback in the spiders on a daily chart last week. And, you know, we're down a little bit today. We're in daily sell mode. Everyone saw that daily sell mode in all the sectors. Quite frankly, the NASDAQ did not do any major destruction. The NYSE, the New York Stock Exchange Composite Index, didn't do a lot of major destruction. The index itself, I want you guys to focus in on this real quick because I know I've mentioned this before in years past, but I haven't probably refreshed your memory. But this is the NYSE, and you look at the NYSE, the New York Stock Exchange Composite Index. And the funny thing is as we look at the New York Stock Exchange Composite Index, the price looks a lot uglier than the advanced decline. Does everyone see that? And the volume. Does everyone see that? Do you agree with that? I mean, the price here looks like the market had a big red down day that kind of popped up, and now it looks like it's rolling over. It looks like almost a bear flag, like it's getting ready to roll over. And then you look at the advanced decline and you say, hey, how come the advanced decline wasn't a lot lower in price with that downdraft? Would that be something of a curious nature to you guys? Because if you are my students and you want to learn from the right way, this should probably be of a concern to you. Well, Adele says yes, and Andy says yes, and Sonia and Eli and Brenda and a lot of people are saying, yeah, that makes sense. What's going on? Well, it all comes down to one thing. Do you know what the hell is in the NYSE Composite Index? Do you have any clue? Does anyone know what the hell this is? The funny thing is, and I'm not yelling at anybody or saying, hey, I'm upset because no one's understands. I'm probably more upset with the fact that educators and people out there don't explain what's in this index. And therefore, if you're going to trade and you're going to use tools, you better know what the hell they are. So here's the issue. Most trading platforms and most trading companies teach you about advanced decline comparative ratio analysis. Larry Rollison says there's a lot of stocks. Right, okay, there's a lot of stocks. You're right. It's a broad-based index. There's a lot of stocks that 50% of the stocks contained in the NYSE are, you're going to drum roll please, are actually interest rate sensitive stocks. And Dave Patterson, you cheated because I talked about this in the seminar yesterday, Dave. Good answer though. Bond funds. It has bond funds. So if people in times of panic are selling stocks but buying bonds, would the NYSE, the advanced decline ratio, give you a good heads up as the pure direction of the market? You were listening, Dave. I give you a pat on the back. Good man. You were. And you can cheat all the time because that means that I'm doing my job and you're learning. That's right. The NYSE folks, believe it or not, about 50% or more now actually have preferred stocks, which issue bonds, and they have bond funds in there. So it's not a pure stock index. So if you're staring at the advanced decline and it's a mixture or more heavily weighted with bond and bond interest rate sensitive stocks or issues, then it's probably not the pure stock broad-based market we want to focus in on. Does that make sense, everyone? And if you're curious just to say, well, why has John done this with the advanced decline in all the different various sectors? It's real simple because like the Qs are cap weighted and so capitalized weighted. And so with the indexes, it's important to take a look at a true picture of the market to find out if there's divergences. Are we selling this market off? You know, and so looking at the NYSE, I find it in periods of market times of potential reversal, it's the sector that I least likely want to focus in on. Okay? So when we take a look at the weekly, we do not have a weekly turn in the markets at all, not yet. On Friday, I think I made comments in the room at the very least, hey, we still haven't even taken out weekly lower lows yet. So as such, a prior week, we looked at and as we take a look at this, the Qs, you know, we might be seeing the beginning. We didn't break below that moving average. So we got to give this a couple more days. So I'd say by Wednesday, actually by Wednesday's close, we'll know, because you got to give it at least a 2-day period. So that's Monday, Tuesdays, Wednesdays, we will know if this market is rolling over, if we make a consecutive series of lower high, lower low readings on between the spiders, the Qs, the Russell, and the diamonds. Okay? Next, I'm going to go over here and I want to take a look at what happened with the McClellan oscillator. And as soon as this tees up, we'll get you right there. Okay, so the weekly McClellan oscillator got up to 54, and typically, anything around the 100 level, you start to really worry about, right? Around 100, we start to worry about when you get to these extreme readings, over 100, 150, and the outlying, between 150 to 200 is really a cause for concern, both on the downside and the upside. That's why we got red and green here posted. So when we take a look, this is the weekly. Let's take a look at the daily. Well, in the daily charts, we were, as I pointed out a week ago Friday, look what the reading was. And I said, boy, the daily McClellan oscillator suggests that we're overbought. And we gave that analysis to you guys, and that's why we bought and entered in the position of the SDS calls. We were right. So the tool worked. We used the right tool at the right time and the right index. And so with that said, the analysis and the technical analysis techniques that we used was dead spot on. So I would worry that the fact that we went from a reading in the McClellan oscillator from about 110 to under 35, it suggests to me that we possibly could see the market, and two things that I would be concerned with. By tomorrow, today's action, tomorrow's close, if the market stays underneath this zero line. So today, if nothing really happens in the market, it's kind of mixed up, down. If we stay below the zero line, we got more downside in the short term in the stock market. All right. If at today's, then we'll have to watch this on the close. We pop back up, then we're probably in a little bit of a trading range. The weekly did not give us a typical significant overbought reading. So I would be extremely bearish on the stock market if the reading on the weekly was at about that 100, 120 level, and we saw a daily sell signal. But we didn't get that, so we're kind of neutral here. One could argue that, well, price made higher highs, and the McClellan oscillator made lower highs. And someone presented that to me a while back, and it didn't turn out to be true whatsoever. So for me, I used McClellan oscillator, and it's a whole different test in itself. I use it from an overbought stage and a zero line crossover component, and I can just tell you, I've used McClellan oscillator probably for 30 years, or not 30 years, maybe 25 years, since after the 90s, the early 90s, something like that. It was something new. I had the fortune, just to give you a little bit of background, I spoke for the IFTA in Sharm el-Sheikh, and many of you remember I went to Egypt to speak at the IFTA annual conference in Sharm el-Sheikh, Egypt. I believe it was November of 2007. On the same plane, we went from Cairo, Egypt. We had to fly to Sharm el-Sheikh. So while we all flew internationally into Cairo, and I will never forget that week, because the head Muslim cleric did not denounce martyrdom status for 7 Muslims who were going to enter into Italy illegally, and they died in a boating accident. And he came that week and said, I do not grant them martyrdom status. So like, Egypt was in an uproar. Egypt had just lost a soccer game to Palestine, and the U.S. was doing their every 2 year, NATO does the war games, and they did it in Egypt. So the Egyptians were pretty, to say the least, pissed off. And so I didn't feel secure, safe, and they had army men everywhere with machine guns, and it was me, Sherman McClellan, Martin Pring, Tom Dorsey from Dorsey Wright, Point and Figure, and Connie Brown, Constance Brown, who does Fibonacci. So I mean, you had like 5 technicians all in the same airport, all going to the same place, and we're all chatting. We were all, believe it or not, scared out of our wits. And in any event, Sherman was giving a presentation. I was giving a presentation, and it was nice to meet him in person and chat with him and discuss his work. And I did listen in, and I've probably got a little bit more out of that presentation. So through the years, I've passed that knowledge on. But I think that there are better tools in analyzing the stock market with testifiable evidence. And with the McClellan oscillator, I find it, and I know there's a bazillion AD line tools out there. There's the summation, McClellan summation index, and his son Tom has done a lot of work. There's just a lot of stuff. I just find the tools that work for me. I don't need to go and expand anymore. I use them, and I use them in conjunction with my indicators, and you know, it does the job. Let's just put it to you that way. So moving forward, and to conclude with, when we take a look at the relative strength analysis and find out, okay, so where have we gone for the year? And the semiconductors, and I want to point this out to you guys, all right? So we're going to be looking for stocks. When I said what sector is entering a seasonally strong period of time and what sector is entering a seasonally weak period of time. Technology starts to end its run over the next 2 weeks, and the semiconductors is only up 18% from a year-to-date basis. That's why we look at this relative strength. Some of the negative sectors, like retail, XRT is actually down 3% for the year. ITB, the home builders, like home builders include like Toll Brothers, et cetera, they're negative on the year. The consumer, XLY, believe it or not, XLY, consumer discretionary, it's negative on the year. The KRE, it's negative on the year. So we have a lot of, you know, surprisingly, a lot of sectors that are negative on the year, and the one that has like gone up the most is the one sector that was more vulnerable for a correction. The funny thing is if PC demand is back but consumers aren't spending, there's going to be a lot of semi-chips on the, sitting on a retail space or computers if people don't pick up and start buying. So that would tell me that perhaps this is one sector, especially the semis, in the next week or so, if we start to see sell signals, I want to be looking at those stocks, because I guarantee you, if that sector's up 18% on the year, I guarantee you a lot of the stocks in that sector are above their 10-day moving average. So anyway, if you wanted to know where we could be looking, there is one area that we would look, and that's what the relative strength chart kind of helps us to quantify. What sectors are overly strong and what sectors are overly weak. Anyway, I hope you guys have a good day. I'm going to go back. I'm going to ask Sonia to project. And so with that said, I'm going back here to spend time with the our folks here at the seminar here in Los Angeles. But as a reminder, I will be here tomorrow at the room back in Florida. I don't know what condition I'll be because I'm taking a red eye, but I will be back here tomorrow. And I'm looking for these particular scans for my own trading for the next week for some position trading. For today, we do have a little report, the housing market index, but I'll be honest with you, between the tensions in that have been developing in Iraq while we were in Las Vegas, I worked, as you know, because I was with you guys, but my wife, my lovely wife, was able to go out to Shadow Creek in Las Vegas. If anyone's ever been out to Vegas, Shadow Creek's at the northern, it's way north of the Strip. Shadow Creek is a little golf course. And it's right next to like an Air Force base. They were practicing drones. They were doing all kinds. She said that they were talking about a buzz that they've been seeing more and more jets flying around, and as if they're getting ready to get deployed. Anyway, just thought I'd pass that information out to you. So we're ramping things up here a little bit, and the tensions in Iraq are definitely mounting. So it needs to be something we need to address as traders, and I think don't underestimate it. The next big thing for the week is going to be the FOMC announcement, no doubt about it. And I think it would surprise a bunch of people. We talked about this last week a little. What would happen if Janet Yellen comes out and says, hey, you know what, we're going to curtail a little bit stronger pullback. Instead of 10 billion, let's bump it up to 15 billion. I don't know if she'll do that with the effect in Iraq, but boy, I'll tell you what, her words and her actions have had, she's been like, as they would say, forked tongue. Woman speaks with forked tongue. She said she was there for the little guy, and she said that right in front of Senate and Congress, we're going to provide liquidity, and 2 weeks later, she said, you know what, get rid of quantitative easing. Boom, 10 billion off the table. I mean, she said one thing and she did another, so we got to be cautious of this one. So with that said, Thursday is when we have the last day for options expiration. A lot of stocks will do what's called pinning. High cap stocks, maybe Apple might pin against 90. I would say some stocks we will be looking tomorrow for some of those opportunities. And I would say another a stock that has an interest, a big mover, which isn't very optionable, but people still like to trade it Priceline. But I'll be taking a look at Google L, and I've got a few other lists for you for tomorrow's session. So anyway, this little relative strength chart here, I mean, boy, that was a huge move, a 10% move if you think about it. We were up approximately only 8% in the semis on May 16th, and we were up almost 19%. So if you wanted to say what's a sector that could provide a potential turnaround, it's the semis, the stocks. The tradable ETF is the SMH. I'll type it in so that you know what I just said. SMH. So if you're looking for an ETF that has a corrective potential, SMH. Maybe we look at this week on any further upside, we look in the semis for a credit call spread for the July expiration there. So that would be one. Credit put spreads in gold, credit call spreads in the semis. And that's all I have for you guys today. And that concludes this week's Planning and Scanning. Everybody, have a great day. You get this chart by becoming by buying the Genesis Professional Package, which has all my charts and all my indicators. Thanks, guys. Have a great week.